Can you actually have two VA loans at the same time? Well, if you check out this COE here or that one there, you'll see that both of these veterans and many others just like them have multiple VA loans at the exact same time. But in this video, I'm going to show you exactly how you can achieve it for yourself by using your VA loan and the ability to put zero down to leverage not only buying property, but also being able to invest in property. All right, so the most important step in this entire process is actually going to be the first one, and it's going to come down to how you buy the first property. And I didn't say buying a first property, I said how you buy the first property. There's a very big difference. As of January 1st of 2020, Congress passed what's called the Blue Water Navy Act, that if a veteran has 100% entitlement intact, which essentially means you don't have any active VA loans on your certificate, you have the ability to buy up to whatever you can income and credit qualify for. So if you want to buy a multi-million-dollar property with your VA loan at 100% financing, you technically can. Which leads us to our second point, and that's going to be county loan limits. You see, county loan limits still come into play when you are using the VA loan, but it is not when you are using it for the first time through what's called basic entitlement. It comes into play when you're using it for a second, third, or however many times you've been using it, and that's going to be what's called bonus entitlement. Bonus entitlement takes however much loan amount was used on the initial property and is still showing on your certificate and subtracts it from the county loan limit in the place that you are looking to buy the next property. For the sake of an example, we're going to use the 2025 minimum county loan limit. The minimum county loan limit in 2025 is $806,500. But there are some areas that are considered high cost areas, which means that some areas, as you'll see on this map, are not only showing up in gray, which is the minimum, but maybe showing up in yellow, light orange, and dark orange. And those areas will have higher county loan limits than the other areas in gray, which means that you potentially could have more entitlement buying a property in those areas. So if you want to know what your county loan limit is, comment below the county and the state that you are looking at purchasing a property in, and I will shoot you a response with exactly what your county loan limit is for 2025. Now, why am I saying the 2025 county loan limit? Well, you see, county loan limits change every single year, which means that if you are looking at buying a property this year, you may not have enough entitlement left over, but maybe next year when the county loan limit possibly increases again, you might have enough entitlement available. Now, I want to dive deeper into this county loan limit so that way you can understand how to calculate your own county loan limit. We're going to bring up a certificate eligibility here. And when we look at the certificate eligibility, what we have to look at is essentially how much entitlement was charged on the certificate for the first property. So what you're going to see on the certificate of eligibility that I have showing up on screen is a veteran that has a property in Nevada and the loan amount was $325,000. Let's say that they are buying their next property in Bexar County, Texas, where I live, which is essentially San Antonio. Well, the county loan limit is $806,500. But what we have to do is we need to take the county loan limit and we need to divide that number by 4. Why that is, I will get to in a second. But we need to divide this number by 4. That brings the number now down to $201,625. What we then need to do is we need to subtract the amount of entitlement that has been charged on the certificate eligibility from that $201,000. The entitlement charged on this veteran's certificate is $80,290. When we subtract that number, that brings us now down to $121,335. But we're not done yet. You remember we divided that number by 4? Well, now that we've subtracted the entitlement charge, we now need to multiply that number to get us back to the total. And by multiplying that number, you'll now see that this veteran has $485,340 available to buy property number 2 with their VA home loan benefit in Bexar County, Texas, or in another county that has the same county loan limit. Now, why did we have to do the math that way by dividing that number? Well, you see, the reason we had to do that is because on your certificate eligibility, it actually states in that little paragraph right around the center of the page that the VA is guaranteeing 25% of your loan. And the guarantee is in place so that way, if for any reason you end up foreclosing on that property or even short selling on that property, the VA is putting themselves on the hook for 25% of whatever that loan amount was to be able to make the lender whole. This is actually part why the VA loan has no down payment and also has no private mortgage insurance, because the VA is guaranteeing the loan. I know I just threw a lot of numbers at you and a lot of jargon, so if you have trouble calculating your entitlement and you want some help, if you have a copy of your certificate of eligibility, comment below exactly how much it shows as entitlement charged on your certificate and also what county you're looking at, and I can also shoot you a response with whatever your remaining entitlement entitlement would be, so that way you know what that looks like. And if you want me to help review your certificate with you one-to-one, I can do that with you if you simply book a call with me. I have a link down below. Now, let's talk about our third step in this whole process. Now you've bought a property, or you already own property number one, and you're trying to decide what you're going to do with buying property number two. Well, now what we need to do is prepare property number one to become a rental. And the first thing we need to do before we prepare that is make sure we have met the VA's occupancy requirement. In the VA home loan guidelines, it requires the veteran to intend to occupy the property as their primary residence for 1 year. But there's a key word in that sentence that I just said about that 1 year occupancy requirement, and that is the word intend. The VA is requiring you to intend to occupy as your primary residence because sometimes things change in people's situations. Sometimes people PCS before they're able to satisfy that 1 year requirement. Sometimes people get a job offer in a different location that requires them to move to a new place, which now means they need to rent the home out. The whole purpose around the word intend is what was your intention on day one at the time that you bought property number one. If your intention was to live in that property and occupy it as your primary residence, but along the way something changed, then the VA understands that and they will actually allow you to rent the property out earlier. But if you don't have anything happen in your situation, then simply understand this. You're only going to have to live in the property as your primary residence for 1 year, and then at the end of that 1 year, you can convert it to a rental without having to contact the VA. You don't have to contact your lender. You don't have to do any refinance. There's nothing that you need to do in order for you to be able to convert it to a rental because you have already satisfied the requirements. Now, what I will say about this, and this is more of a bonus tip around all of this, is if you own rental property or your intention is to own rental property and it's being generated through you doing an owner-occupant loan, I don't recommend you only living in the property for 1 year. I actually recommend you doing it for at least 2 years. If you live in a property for 2 out of the last 5 years, the tax code states that if you sell that property, you're exempt from capital gains taxes of up to $250,000 if you are single, or up to $500,000 in gains if you are married filing jointly. Now, sure, you're wondering, well, Josh, why do I care about selling the property if the whole point of this video is to own rental property? And that's simply because plans change, things come up. Maybe you have a great opportunity that arises that is a different venture that you want to dive into, or maybe you want to sell the property and pull that equity out to be able to put it in your dream home. Regardless of what that is, the reason I am even bringing this to your attention is because plans change. And if plans are going to change, you want to try to have as many things in your favor to work with. The other thing that I want you to do while you're living in that property is I want you to prepare it and think like a landlord while you're there. You see, when you get a home, or at least I know when people typically buy a home, the goal is to make it yours. But where I think this can go wrong is if you know that you're going to convert it to a rental, a lot of times people put a lot more into a home that they're not actually going to enjoy. And they sometimes think it's going to equal a dollar for dollar increase in what they could actually receive in rental income. There is a lot of mistakes that can be made when improving a property that sure may help the overall value of the home, but it's not actually helping the rental value. So avoid making those bad improvements and upgrades so that way you don't find yourself making some mistakes that I will admit I have made, and that's why I share that so openly in my videos. Another thing I want you to do is start getting an idea of what that property could possibly rent for on the open market. And you can do this by having conversations with a property manager to get an idea of what your rental market analysis is. They'll have the ability to pull comparables of properties similar to yours on the market to get an idea of what those have gone for in rent. So that way you know what to expect with your property. You'll then have the ability to know how that rental income will help support your mortgage payment when it actually comes time that you do rent that property out. The other thing that you're going to do is build a relationship with that property manager, so that way you know that the person that's actually looking after your essentially most valuable asset is someone that you actually can trust. You don't want to wait until the day you are ready to move out that home, or even a few weeks until you're ready to move out that home to find a property manager, because now you're essentially having to put your trust in somebody that you don't really know yet, and it's probably not going to be as comfortable of a situation as you may think it is. Our next point in this whole process is going to be having a rainy day fund. This is just simply going to give you peace of mind. When you're converting a property to a rental, a smart decision to make is actually having a bank account created simply for the expenses that property has. So if it's your mortgage payment, repairs, anything like that, that account is for that property. And one thing I would recommend is that rainy day fund being in that account and it equaling out to at least 3 to 6 months of whatever the monthly expenses are for that property. So for example, if your mortgage payment and the expenses for that property are $2,000, I would recommend having between $6,000 to $12,000 set aside in that account for those potential rainy days. So that way, if you end up having repairs, if you end up having to evict somebody, or maybe you have a vacancy, you know that you have some money set aside for being able to cover that mortgage payment and whatever other expenses that you have. Now, the thing to remember here is I'm not telling you that you absolutely need that rainy day fund. This is not a guideline or a rule. It's just something that I like to recommend to people to provide added comfort when becoming a landlord. Our next step in this process is getting pre-approved, and doing a pre-approval for property number 2 is going to be slightly different than when you did a pre-approval for property number 1. Now, why is that? Well, it's because you now own a property that has a mortgage payment. And when you're going through a pre-approval, what they're going to look at is your income, your assets, your credit, and your monthly debts. And the difference between how you look now and how you looked when you bought property number 1 is you have an additional large monthly debt that you didn't have when you bought the first property, the mortgage. So what do they do here? Well, when you are doing what's called a departing residence, which means you are taking a property that you currently own now and you are converting it to a rental property on the VA loan, it actually allows you to offset up to 100% of your mortgage payment. So you remember we used the example of a mortgage payment being $2,000 earlier. Let's say that that situation still applies. Well, the VA says that as long as your rental income is at least $2,000, they will use that as additional income alongside whatever other monthly income you have to basically cover that original mortgage payment that you have. Now, if the rental income exceeds the mortgage payment, they can't give you that as extra income. They can only give you up to whatever your mortgage payment is. If for any reason the rental income that you may be receiving is less than your mortgage payment, then they're just going to give you whatever that amount is, and then the difference would essentially just be added towards your other monthly liabilities. Now, I want to dive back into crunching the numbers in entitlement because there was one major piece that I actually didn't mention, and that's going to be the ability to exceed your remaining entitlement. Remember, we used the example of a veteran that had remaining $485,000. Well, what if that veteran said, I need more than that? Well, you can actually exceed your remaining entitlements. So in this point, we're going to talk about how that works. Simply put, the VA only requires a 25% down payment whenever you exceed your remaining entitlement. So if you have $485,000 remaining and you are looking at buying a $585,000 house, which is a $100,000 difference, the VA only has a 25% down payment of that $100,000, which would essentially be $25,000. But if you only exceed your remaining entitlement by $10,000, well, then that down payment is only $2,500. So if you're looking at still trying to use your VA loan and feeling like you don't have enough entitlement left, you still could use it. You just would have to put that 25% down payment of the remaining amount. Now, I know earlier I said the most important tip in this process was how you buy property number 1, but I actually would say this last one is going to be the most important. And that's going to be teaming up with people who specialize in the VA loan. And that means the lender and also the realtor. Now, a lot of veterans, when they hear this, they just jump on Google and they search VA lender and they pick the person that pops up first because they have the largest marketing budget, let's admit it. But I recommend working with a mortgage broker who specializes in the VA loan. And then I also recommend working with a real estate professional who specializes in the VA loan. Why? Because the VA loan has different guidelines that are in place that also affect the property and the loan, which means that if your real estate agent doesn't understand the property requirements that are needed to get a VA loan, you can find yourself wasting a lot of time. And if the lender you're working with doesn't have the best options available to you by being able to work with several different lenders and shop around for the best rates and terms for you, then you could find yourself thinking that what you're hearing from one person is going to be the best option. You see, I'm a mortgage broker and I have the ability to work with over 40 different lenders around the country, which means that you know that you only need one loan application and one credit pull, and then me and my team can find the best options available for you on your VA loan journey. And when it comes to the real estate side, I have real estate agents all around the country. I have over 20,000 real estate agents that are now in our network that specialize in the VA loan, and I can connect you with somebody in your local market to help you find your future home number 1 and home number 2. So you have it, how to have multiple VA loans at the same time and use it to leverage and build wealth. If you got value from this video, do me a favor, hit the like button down below. And if you haven't already, do me a favor, subscribe. Join the community. It's completely free. And I am constantly providing updates on the VA loan and the market throughout the week. The last thing I want to leave you with, it is the most important thing. Jesus loves you and he paid the ultimate price for your life. So if you turn to him, trust in him, and believe in him, he has a beautiful plan and purpose for you. I'll see you in the next one.